Today, we will be presenting on the conclusion and recommendation to potential investors on whether they should invest in Nestle company. First, we will start with an overview of Nestle Malaysia Berhad. Nestle was founded in 1912 in Penang and has grown to be a leading name in food and beverage industry in Malaysia, renowned for popular products like Milo, KitKat, and Maggi. Their mission is to enhance the quality of life by providing nutritious, high-quality food while ensuring environmental sustainability. Nestle is dedicated to providing high-quality, nutritious, and affordable food options, ensuring that they cater to a wide range of consumers. Their commitment to environmental sustainability is evident through their ongoing efforts to minimize their ecological footprint and promote a greener future. Next, we will see about the company background. So there was guided by a board of directors and a dedicated management team. They have a clear financial performance disclosure and adherence to ethical conduct, and they have a wide product range, includes baby food, breakfast cereals, coffee, dairy products, frozen foods, and pet food. Next, we will see some strategic goals by Nestle. The first one is product innovation. They focus on incorporating high fiber ingredients such as whole grains, vegetables, nuts, and seeds. Moreover, expanding nutritious food options. Nestle also reduced the sugar and sodium level across their product portfolios, working towards nurturing a healthier nation. This is to empower consumers with the knowledge to make informed dietary choices. Clear product labeling and portion guidance are provided. The second strategic goal is sustainability initiative. Nestle also aim for zero waste to landfill factories, where they use 17% of waste to generate energy, 26% organic materials converted to animal feeds, 19% recycled, 38% organic material to fertilizer. They also use biomass energy, where they implement biomass boilers at their manufacturing sites. Other than that, they reduce the plastic usage by switching to more eco-friendly alternatives and launching a collection and recycling campaign through Project Safe. Next, we will see about the profitability ratio. So from 2019 to 2023, Nestle Malaysia Berhad has maintained a consistently high return on equity (ROE) above 97%, showcasing strong profitability and effective use of shareholders' capitals. So Nestle has been able to keep its return on equity high. This shows that it can handle changes in the market and run efficiently. Even during the pandemic, which caused some challenges and extra costs, the company's ROE only dropped a bit. By 2022, they managed to bounce back with a ROE of 99.05%, demonstrating their strong management and ability to recover quickly. Other than that, they have a strong brand portfolio where they are globally recognized, and Nestle owns a range of well-known brands like Nescafe, KitKat, and Maggi, which have strong market positions and customer loyalty. The product diversity also helps to mitigate risk and ensure steady revenue streams. Conversely, Rex Industry Berhad has struggled with a high variable and generally negative ROE, indicating significant profitability issues and effective capital utilization. So some causes that cause Rex company having unstable ROE is lack of innovation, failure to innovate or adapt to changing market conditions, resulting outdated products and loss of market relevance, affecting their revenue growth. Other than that, inadequate management practice, which they have weak internal controls, lack of accountability, and poor decision making, can undermine the company's financial health.
Liquidity ratios are the second type of financial ratios that are usually computed in order to show the cash levels of a company and measure its ability to pay its short-term commitments and current obligations. Current ratio is the most common indicator of the liquidity of a company. From the computation made above, we can see that Nestle only has enough current assets to pay off 71% of its current liabilities in the year 2022 and 61% in the year 2023. Although the liquidity ratio of Nestle Malaysia Berhad has been lower than 1 throughout the period, indicating a potential liquidity problem. Strong brand equity, sustained cash flow, and efficient working capital management alleviate this problem and ensure operational stability. Whereas in comparison to Nestle Malaysia Berhad, Rex Industry Berhad exhibits a current ratio that is constantly above 1, indicating superior liquidity. However, smaller businesses like Rex Industry Berhad may encounter more substantial difficulties in managing working capital, indicating the possible inefficiency of asset management and the increase in term debt. Efficiency ratios are the third type of financial ratios used to analyze a company's ability to effectively employ its assets and operations to generate income. Trade receivable collection period is used by companies to ensure that there is sufficient cash flow collected from creditors for debt payment. The receivable collection period for Nestle was 24.38 days in 2022, while the year 2023 stated 23.97 days. It is clear that the company collected its payment faster in 2023 compared to 2022. The collection period of Nestle Malaysia Berhad is shorter and shorter, highlighting its effective credit control and efficient collection, thereby improving operational efficiency and cash flow stability. In contrast, Rex Industry Berhad's collection period is long and fluctuating, ranging from 64.43 days to 84.81 days, indicating that it faces great challenges in account receivable management, leading to the instability of its cash flow. Customers experienced financial difficulties, which resulted in payment delays and longer collection times, particularly during the pandemic. Industry changes are particularly important since smaller businesses, such as Rex Industry Berhad, could have less negotiating leverage and more accommodating credit conditions, which makes it harder to recover receivables on time.
Next, two ratios, leverage ratio and interest cover, will be analyzed from a long-term solvency point of view. Leverage ratio measures a firm's ability to cover its long-term debt obligations using its assets. A leverage ratio larger than 1 indicates potential insolvency and increased financial risk. From our findings, there's a decrease in the debt ratio in the year 2023, reflected that Nestle has either increased in terms of its asset or has decreasing liabilities. This shows that Nestle has better debt management and fewer assets to fund operations for that year. One limitation of examining a company's total debt liabilities is that it does not consider the company's ability to repay interest on its outstanding debt. This is an issue that the interest coverage ratio addresses. The interest coverage ratio of Nestle Malaysia Berhad shows a downward trend from 2019 to 2023, but is still stable overall. This reflects the company's ability to meet its interest obligations and maintain financial stability. In contrast, Rex Industry Berhad's interest coverage ratio was negative, falling significantly in 2019 and 2023, indicating that the company is facing serious problems and persistent profitability and debt management problems that have not been resolved. Dividend yield measures a firm's annual dividends against the market share price. Nestle Berhad has demonstrated a consistent commitment to create value for shareholders, and the dividend yield has remained stable and increased significantly in 2023. This reflects the company's sound financial position, prudent financial practices, and its ability to generate sustained returns for investors. By contrast, Rex Industries Berhad's dividend yield is volatile, with no dividend paid in most years except for the merged dividend in 2021, reflecting the financial difficulties the company faces and focusing on managing debt and liquidity rather than shareholder returns. EPS measures a company's profitability per share. Nestle's EPS was 264.5 cents in 2022 and increased to 281.4 cents in 2023, showing improved profitability. A higher EPS can lead to a higher share price if the market values the growth. If Nestle keeps increasing its dividends along with EPS, it could attract more income-focused investors. Lastly, the P/E ratio helps investors see if a stock's price is justified by its earnings. For Nestle, the P/E ratio dropped to 41.79 in 2023. This means investors were willing to pay 41.79 times the earnings per share in 2023. The drop in the P/E ratio, along with rising EPS, suggests Nestle is becoming more profitable and more appealing to value investors.
Here is a quick comparison of Nestle and Rex in terms of financial performance. The financial performance of Nestle have a strong profitability, efficient liquidity management, and reliable shareholder return. This performance makes it a stable and promising investment opportunity. The financial performance of Rex is instability. It have a poor profitability, declined current ratio, and inefficient invisible management. It also has poor solvency with negative interest cover ratio and inconsistent dividend payment. From the comparison, we can find that the financial performance of Rex, which is a competitor of Nestle, is not as satisfactory as it should be. Or we can say the financial performance of Rex looks bad when compared to Nestle. But this also highlights the strength of Nestle. So let's go into the recommendation. In view of the detailed financial analysis, potential investors are advised to consider investing in Nestle due to the company's good financial position, efficient operational management, and strong commitment to shareholder value. The return on investment of Nestle has been high all the time, which indicate that it have the potential of low risk and high return and show its ability to effectively use shareholder capital to create profit. Although the liquidity ratio is less than 1, Nestle's strong brand, reliable cash flow, and efficient working capital management reduce the liquidity risk and ensure operational stability. In addition, the company's short collection period highlight its effective account receivable management and future improved operational efficiency. Moreover, the stable interest guarantee ratio of Nestle reflects its sound financial position and responsible debt management, giving people confidence in its long-term viability. The growing dividend yield demonstrates that Nestle is committed to providing reliable return to shareholders, which is an attractive investment for investors looking for stability and income. So that's all for our present. Thanks for your attention.